Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Good afternoon, good evening, and welcome to Traders Workshop. I'll be your host, Tom Schneider, CMT, with NinjaTrader. And this week, very special guest, very special topic. It's my pleasure to welcome back Larry Williams from ireallytrade.com. It's going to be talking about commitment of traders. Larry, how you doing?
Tom, great. Thank you for having me back, and nice to be back with my fellow ninjas. Let's see what the little ninjas can come up with this time.
Yeah, it's great to see you. It was great to see you in April when you were in New York, but always great to have you here. You're always welcome back here. I do want to ask viewers, though, to participate in the chat. This is a special thing we're doing here at Traders Workshop. We're going to encourage you to join the chat so that you can ask Larry questions. Q&A about the markets, about trading, whatever it is. You can go to ninjatrader.com/events. And right there's a big play button. Hit that play button, put in your handle, and ask Larry a question. I've got my crack team back at Mission Control. They're going to forward me the questions. So if you have questions for Larry, we'll probably do that at the end, because Larry has this great discussion about gold. Larry, how you been?
Good, Tom. I'm up in Montana for the summer, and the weather's been a little cold here, not as warm as every other place in the States. So I've had a great time here. It's nice to be in Montana with a lot of cowboy and Indian friends.
Bucking the trend a little bit with the weather. I think it's been hot everywhere else. When we talk to our viewers on our bookend shows, it just seems like we're seeing double and triple, high double and low triple digit numbers. It's great to hear that you're not suffering.
Yeah, we really avoid it. I don't know why, but it's probably been one of the coldest summers I can remember. We've had maybe one good week of summer. That's pretty unusual weather for Montana.
Wow, that's great. So, when we were talking last week about the topic, really, really interesting, because I think it's a part of the market that people know about, people might hear about. Maybe you haven't. Newer traders might not hear about this, but the commitment of traders is really unique to the futures industry, and can provide a lot of information to traders like us.
It is. It's actually unique to the world. There's no other market any place in the world where we can find out what the participants are doing on a weekly basis. Are they buying? Are they selling? How much are they buying or selling? So it's a remarkable report. It started actually under the United States Department of Agriculture way back in the 1960s and 70s. It was reported monthly then. We got a little sheet in the mail. It was sent third-class mail, so we got it about a month late as well. But it showed what was happening on a monthly basis. And eventually, the Commodity Futures Trading Commission took over the U.S. Department of Agriculture's function. And then they were doing it every 2 weeks, and now we get the report every week. Every Friday, we know what's been going on in the market up to Tuesday of that week. So today, at the end of the market, the books will close, if you will, and then the CFTC will report the net long positions of all the players in the market as of tonight's close.
So you mentioned it's unique to the world. What is interesting is you think about the equities market to make a comparison, and you think about the different institutions. There's no way they would share this kind of information of what their intentions are, right? So why does it still persist in the commodities world?
Oh, you mean those Wall Street wizards wouldn't want us to know what they're doing? Yeah, well, they do have to report insider buying, and then the funds have to list what stocks they have. But interestingly enough, and you make a good point there, Tom, if a fund buys a stock, they don't immediately, if they liquidate it, say tomorrow, we don't know about that for maybe a month or 2 months later. So there's a huge delay on stock market information. And I guess they like it that way.
Right, right, for sure. So the commitment of traders report that we get from CFTC, you can go to the CFT website and get that. But you can also get it on NinjaTrader. It's an indication that an indicator that we update with that weekly data for most. I shouldn't say most, but a lot of markets that are trading at the CME, for instance.
Yeah, most all actively traded markets are reported in Ninja. There's a couple you probably don't have, like milk, because it's just such a thin market. But for the most part, the markets that we generally trade are going to be covered by the commitment trade report. And what I found, Tom, I mean, I was the first person to write about this way back in 1973. Nobody was using it back then at all. Nobody wrote about it. And there was actually one speech by a guy on cargo commodities who talked about the commitment trade report in a lecture he gave, and that turned me on to what's this about. And then I started following it, using it, writing it, and now there's a lot of people that have taken my work and gone farther with my work. I've added a little bit to my work as well, but the real basics of this I found work the best in the gold market. And I think it works in all markets a little differently in each market because markets have different characteristics. But in the gold market, oh my gosh, this has just been an amazing indicator.
Well, that's great. And I have a question for you after your presentation is done. If we don't get to it in the presentation itself, I'm going to put that question aside. We have some questions coming in, but let's get started. I think you have a great presentation here.
Great. Let's do it. Let's look at who drives gold. I mean, if we can find a driving force of a market, clearly banks and governments in the interest rate market, but who drives gold? I'd like to give you my idea today of who I think drives the gold market. And the gold market, it is so full of rumors. You got the gold bug, you have the anti-gold bug guys. You have the idea that it's going to be anti-inflationary, or that well, if we have recession, gold will go up. The stock market crash, gold will go up. Wrong. If you look at the major stock market crashes, gold also went down. So this is an old wives' tale. During a time of recession, everything goes down, except maybe the price of alcohol. So gold doesn't really protect you from big declines. Look at the declines we saw last year. Gold went down. Central banks have a lot to do with it because they are financing their currencies, usually backed by gold in one form or another. Jewelers, of course, a huge demand for jewelry, and chip makers are using it. And the one I kind of like the most, talk show advertisers. We could probably make a good anti-index here. When the number of talk show ads for gold gets to some point, you should probably sell gold, because that seems to be a huge driving force now on the talk shows of, oh, gold's going to go up, gold's going to go up, may not. But the commitment to trader report really shows what's happening in the market. This is the commitment to trader report. This is through August 15th. And we look at the producers and merchants. These are the processors and the users. People actually use gold. They buy it and they either produce it or they use it. And we see that they were net long 17,000 contracts, net short almost 40,000 contracts. Then you have the money managers. Look at them, the difference. They're long 113,000 and short 83. So we see the producers, the merchants, the commercials are net short. The managed money guys were net long. And finally, you have the public. They don't call it the public in the report. You need to notice this. They call it other reportables. In other words, if you're not a managed money and you're not a producer, you're the public. And the public was heavily long gold, 119,000 contracts, only short 28,000 contracts. And then you can look at the changes from, did the commercials increase or decrease? They decrease. This is the short position, right? Long short. Their short position was decreased from the prior week, and they added to the long position. You can look at the percent of open interest that each of the categories held. So it's really interesting. You can find out so much about who's actually buying and selling gold. This is not rumors. This is not some right-wing talk show host or left-wing person saying that gold is a disaster. You should never invest in it. There's been so many rumors about gold. When we first started following gold way back in the 1970s, I distinctly remember the Federal Reserve System having a lecture, they kind of a Chautauqua circuit they went on. I went to it in San Francisco, and they told us what a bad investment gold would be. That gold was just a meaningless currency. It had commercial value, and that was it. Well, totally wrong. So you have to watch out for what you're being told by all the parties. And that's why I like, well, hey, let's look at what's going on in the market. Who's buying it? Who's selling it? How much are they buying? How much are they selling? That's really where the tire meets the road right there. So let's look at the players. Let's identify who these are. The producers, merchants are the people who actually produce or use it. So this would be a miner or a jeweler or a chip maker. Somebody's actually using the product. Then you have managed money. In the old days, that was called large traders. Now we call it managed money. These are the funds. And then the other reporters, that's the small traders, that's the public. For the most part, people like are probably watching today. So these people act differently. And if we understand their function in the marketplace, it can give us a lot of information in the market. So let's look at that. We want to look at the changes we talked about, managed money, again, the funds and other reportables, that's the public. We want to really focus on all three parts. Of course, who do you think is going to be the most wrong? Probably the public, small traders. And that's what I'm showing thanks to Ninja. The green line is the net position of small traders. Notice when the market runs up, small traders get bullish. When the market comes down, small traders sell. They never buy at a low. You'd think they're heavy buying. Look where heavy buying is at market tops. But at market great buy points, no, they weren't doing any buying. And that's the history of this report. We're going all the way back into 2007 here. And you see, generally speaking, whatever the market does, that's what the small traders are doing. They are really trend followers. Look at this, just how closely the green line, their net position, follows actual price action. Now, here's a great point where you want to be really long at the market or over here, and they're not. They were heavily long here, heavily long here, heavily long right here. That was the largest net long position they had for a couple of years at a real good point to sell. So small traders, year in and year out, are doing the wrong thing. And they are buying strength and they are selling weakness. You never see in this market, in gold, small traders being very correct. Now, as an aside, in the meat markets, it's totally different. You have a lot of producers that don't have enough production to have 100 contracts. To be a large trader, you have to have 100 contract position. But there are a lot of individual producers throughout America for hogs and cattle that know what the heck they're doing, but they don't hedge in 100 lots. So there, the small traders can be pretty good. With the exception of that, though, those two markets, I found the small traders, unfortunately, are almost always wrong. Here we are right up to date. You can see again, the last really great buy point in gold, 2022. They weren't long. They were heavily long at the peaks of the marketplace. So how can we use this to our advantage? How can we kind of codify this other than just looking at the charts? A couple of ways I'd like to share with you today. One, we can look at their absolute levels. So I've drawn horizontal lines. This is when they're excessively long in the market and when they're excessively short in the market. Notice when they're excessively short, those have been really good buy points in the marketplace. Look at that. When they're excessively long, those have been usually pretty good place to sell. So you can just look at their net long position. Are they been really, really bullish? More bullish now than, say, for the last year or 2 years? If so, you got to be really careful about being long gold and or thinking about selling gold short. They are a contra trend indicator. When they are very negative at very historically low levels of optimism, they don't have many long positions on, you want to think about being long. It's a great indicator to give you perspective on the marketplace. Here we see it brought up to 2023. These are the same levels we were using before. They're really negative on the market, and all these will represent pretty nice. Look at that, about what is that, 8-9 week rally in the market, 7-8 week rally in the market. Very negative in the market. Prices rally. It's almost funny in a way. I mean, it's sad, but there's a great buy point, and they didn't want to be buying. We saw that also at the end of 2022. Historically, this was lowest amount of buying or the largest net position that had for a couple of years, all the way back to 2017. And gold rallied. So it's a great indicator to give us perspective of, am I in an area where I really want to look at being long gold, thanks to the almost always wrong small traders.
But and Larry, just to jump in here real quick, you made a comment
Please.
about the talk show ads that you saw. I would imagine the talk show ad frequency would track that price of gold, as well as like you saw the small investor, the small trader positions as well, right? As gold increases, you hear more and more ads, like you said. Maybe it's time to get out of my long position. When you hear that increased frequency, I would imagine it would track similar to these charts as well.
Yeah, I definitely think so. If we could track those talk show ads, and the more flamboyant they get, oh, gold's going to rally because of some economic reason. In my mind, gold doesn't rally because of deficits. It doesn't rally because of almost anything other than, are the commercials buying it? This is a commodity. For Pete's sake, think about it. Like wheat or corn. It has an emotional attachment to it because of the idea of what it can do. But remember, in 2022, stocks crashed and so did gold. I mean, you see that all the time. Gold does not protect you from stock market declines. Never has. The crash of 29, gold went down. Crash of 2008, gold went down. So these guys have it all wrong. And the more fervent they get about it, the more wrong they're going to be, which is probably be more exciting for us to look at what to do. So here's where we are right now. We're not at a historically low level. Here's the historically low levels. I'd love to see the market dip back down to that, to say, yeah, here's a point where you can just about push all the chips across the table. When you get these really low levels, that's where you really want to be thinking about some serious commitment to the gold market. Now, we can make an index out of that. I first started doing this many years ago, and it's been picked up by everybody else. But we made a twist to it that is in NinjaTrader in our stuff. So we look at it a lot differently than anybody else does in terms of the Commitment Trader Index. And because of that, notice when it's in this low zone, in other words, they haven't been doing any buying, they've been short. Look at the buying points that have been set up. Entire accumulation area in here. So where are we now? Well, the next really great buy point in gold, as I see it, will come when the small traders get back into this area, because we know when they're in this area, look what happens. Gold rally. It doesn't matter for an uptrend or a downtrend. When they get that excessively negative on gold, that's when we want to buy gold. So we're not there yet. I wish we were. There's some other indication we'll talk about in gold, but for look at how they're wildly bullish up here. Look at that. It's like, whoa, great time to sell gold. Same thing up here. Great time to sell gold over here. Oh yeah, whole distribution area. So wow, what a great indicator we have. And this is where we develop an index to get the extremes in their buying based on the net position of the small speculators. And that helps us create our indicator that we have in NinjaTrader. So let's leave the small traders alone for a little bit and look at the large traders or the funds. These guys are trend followers too. The blue line is their net position. Market goes down, they go down. The market rallies, they buy. Market comes down. Look how closely their net position follows actual price. It's just incredible. So you would think that funds would accumulate gold, but they don't. Here we are right up to date. You can get a pretty good idea of what's been going on and see how closely that blue line actually follows price. If anything, I think that funds are a driver of price. They drive price. They're the momentum player in the market. They get excessively long, the market tends to rally. But again, we see they're almost like the small speculators. And it's interesting because you think, gee, the large traders are heavily long gold up here and they're heavily short gold down here. They don't have any position. How can that be? How can they be making money? Well, first of all, some of them don't. But this is the way most funds operate. As the market rallies, they add to their position. So they might have 100 contracts here and 50 contracts here, 75 here and 10 over here. So their average price is over here. So the fact that it looks like they're excessively long here, and they were, but remember, they started a position here. They scale into a position. So they'll buy 100, they'll buy 25, 50, 25, 10. So it looks like they're always excessively long at market tops. It's the number of contracts, but their actual balance may have been at a lower level. We can see that in another fashion. I'm going to show that in a moment. Also, remember how we talked about small traders, Tom, have zones of they're very bullish and very bearish? Same thing with the large traders. This is the zone when they're really bearish on the marketplace. You can see what happens. And when they're really bullish on the marketplace, they think this is only going to go straight up. They have a huge number of contracts on. Well, that's a danger area in the marketplace. And what I like about this, Tom, it gives me some really belief. It isn't just a line on a chart, a moving average, or something that changed. This is real money, big money that's actually operating in the marketplace.
Yeah, and Larry, to that point, real quick, our friend Ralph A. Campora, he always comes back to the first thing you look at is price. Before you look at anything else, you look at price in any market. And this is an extension of that. Commitment of traders is actual data. Like you said, it's reported data. So it's similar to price. And you've turned that into an index, but it's based on price. It's basically price or value. And so I think it's a little more understandable, a little more real than, let's say, like you said, a derivative of price, which is an indicator.
Well, not only that, you walk into a room and you see a beautiful woman. That's the first one you look at. That doesn't mean it's the best one. Might be the worst one. So I don't want to look at just price. I want to look at, is there some depth to this person? What's really going on there? And that's what this does for us. Excuse me. Here I've shown it again. You can see it. We can draw trend lines on it. Pretty good trendable because it does represent price action. And again, you see there's such a driver of price. So it does give us an additional depth, kind of an X-ray view of what's really going on in the marketplace. Again, this is real money. And when they get excessively long, we're close to top. When they're very bearish on the market, as they were here, as they were over here, guess what? We start to rally. We can also put trend lines on that. You can see how I've done that here. So a couple of ways you can use this. You can use the index, as I've talked about, or the net position. In my courses, I go to even another level of my really favorite way of using it. But it's really a really cool indicator you can use. Here it is as an index. Now we're going to look at a percentage of their buying over the last time period. And you see when the large traders are excessively bullish, that's above this horizontal line. Well, look where we are in the marketplace. We're at market peaks. Just time after time. It's gone on for years. There's last time was over here. When they're really negative on the market, well, gold's set up to rally. Look at that. Boom, gold goes to rally. And what's a really great thing about this to me is it's been this way since I've been following it in the gold market since when we started trading gold in 74. It's been that way. I mean, this is so consistent. This is how the markets operate. When the commercials we'll look at the commercials in a moment, heavily long, we tend to rally. When the large traders, the funds are really excessively long in the market, we tend to decline. And what a great setup tool. This is not a timing tool. Tom, as you know, it says, now I can bring in something else to say, okay, let's buy or sell on this day or here at a trend line or whatever. But it's a great setup tool in the market. And again, look at the net positions. Look how closely their net position follows price. They're just price followers. The last time they were excessively bullish, right up here, and gold's come down. The next time we get a really good buy signal would be when we see the COT index get back into this area. And again, if you look at other COT indexes, you won't get any pattern like this at all. They're very totally different. But the next buy point for me will be when we see the COT index get here. And again, as Tom mentioned, that's released every Friday. You can get it in NinjaTrader Saturday morning. It'll be there in your data. And you can take a look and see if these guys been buyers or have they been sellers in the marketplace. Now, the commercials are trend enders, and we have to think of the commercials differently. And you really have to change your perspective here about what I'm going to talk about. The commercials hedge production and usage. They're not speculators. To be listed as a commercial in the commitment to trade report, you must be a hedger, which means you are going to, if you're a producer of gold and you see price at $800 an ounce, you're going to sell quite a bit of your production. You see it at $1,000 an ounce, you'll sell more because you know you can produce and deliver to that contract. So producers are not using the market to speculate as you and I are, or as the large traders are. They're not speculators. They don't try to buy bottoms and tops. That's not their business. They're hedging their position. This means that they sell rallies and they buy declines. Just think about it. If you're you raise wheat, right? And you see wheat is above your cost of production, you're going to sell some of it. If it goes way above your cost of production, you'll sell more. If it goes way, way above, you'll sell all you have. Are you negative in the market? No. You're selling your production in advance in the future market. Doesn't mean you're bearish. It means you're using this as a business purpose. You're not a speculator. So don't think these guys are buying tops and bottoms. They move into the market and move out of the market. They are hedgers. Big difference than what we see the small specs and the large traders doing. And now we can take a look at gold, and you see that I call them trend enders when they get really bullish gold. Well, there we are. Large bullish positions in gold, largest they've had for years. Great buy point in the market. When they're excessively, we just see the opposite time after time. Here we are. We bring this up to date for you right where we are right now. They were excessively long back here. Markets rallied. Excessively short back here. Peaks in the market. Selling points in the market. Same thing here. They're very negative in the market here. And the market had a huge up move and came right back down. And they started buying right here. Very bullish on the market over here and over here. Lifetime buying opportunities in the market. You can see again, so, and the red line you're seeing, just so we're clear, this is their net position. This is how the higher the line is, the more long positions they have. The lower the line is, the more short positions they have. And they've been adding to their long positions. Seeing it get over here would be very, very bullish. Now we can look at that in another way. We can look at the index. And I thought you might enjoy this, Tom. I took the index 10 years ago. Same index we've been using for 25 years now, but to show the stability of this data, notice every single time we're in the buy area of the index, gold has rallied. Again, it's not a perfect timing tool, but it says any long-term trend entry change you want to take in these bullish areas in the gold market. That's why I think of all the commit report data, I think it works the best in gold. Now we can bring it right up to date. Oh, look what just happened. The index just got bullish in the gold market as it was back here, as it was over here, was over here, was over here. So we just entered the point where the commercials have become buying gold on a aggressive basis compared to their historical perspective. We can see that in the raw data. But when we put it into our COT index, they just got into the buy zone, which means we'll be looking for buy signals on the gold market. And again, I mean, what an amazing record. And when they're heavily short the market, it comes down. It's almost like clockwork. So if there's anything that's going to help us understand the gold market, I think it's going to be the commitment trade report. Now, there's another indicator we can add to this in NinjaTrader, and that's my valuation. This is the most interesting indicator that I've ever come up with, in my humble opinion. And that's to look at the value. Can we put a money flow and we can put a value in this market? Well, here's the money flow index, which is similar to the commitment trade report. We'll talk about valuation in a moment. Here's the actual commitment to trade report up here. And here's my synthetic commitment to trade report. And it follows the actual commitment trade report really closely. Notice that they all come down. We have buy signals about the same price. We use that as well. It's a little more accurate, actually. Got a nice buy signal right there. So we can use the synthetic index of what the commercials are doing, because sometimes we don't have a commitment trade report. When the government shut down or holidays, or no COT report comes out, so we can use our synthetic report instead. Now, the valuation is a model that is in NinjaTrader. I think we can make a valuation model for gold. Gold is overvalued when this gold line is in this area, and it's undervalued down here. So think about if we have a time in the marketplace where the commercials are heavily long, we're looking to be a buyer, and we then get undervalued right in here. Oh, this market's undervalued. We want to look to be a buyer. We have confirmation. When we're undervalued and the commercials are heavily long, it's a great opportunity in the marketplace. Commercial, we're big buyers, the market's undervalued. We're undervalued over here, the commercials buy. So it's a nice way of confirming your trade to use that valuation model. By the same token, we're heavily overvalued over here, and the commercials are big sellers here, and we're overvalued. A wonderful point to look for sells in the marketplace. So I like to see the market as kind of a combination of ingredients, and if I can put a couple of these things together, all the better. I'll start to take questions in a moment. I do want to do a gold forecast. Excuse me, this is based on cycles. It looks like we're going to rally a little bit higher in here. The next really good buy point in gold should come around the end of October. Notice the cyclical lows have been pretty consistent in this pattern. So we should be in a rally phase now, but around the end of October, we should see another up move begin in the marketplace that we saw back here, as we saw here. This is the cycle that's coming up over here. So Tom, I bet we've had some questions come in, huh?
Sure thing. And thanks for that explanation. Real quick, before we jump to the questions, I just want to get one out of the way. Commitment of Traders Report. This is a report. It doesn't get updated, right? It doesn't get updated with new numbers. It's basically a weekly report that when it comes out, you can pretty much trust the numbers, correct?
Right. The numbers are the numbers. They're not going to change the numbers. I don't recall they've ever been changed. In fact, these are the numbers as of on that day, what the net long short positions of these people were. This is not like a moving average. It changes. This is what was actually on the books on that given day.
Awesome. Thank you. Just want to clarify that. So we have several questions. DT is the first one I'll go to. Hi, Larry. Thank you for doing these seminars. Any insights in trading crude oil? And I'm doing them in order, so we can come back to it if you want. Is copper still a good leading overlay for it? So maybe we want to, think about crude and copper together.
Well, I happen to be long crude and copper right now. I've been really worried about both positions. They're short-term trades for me. A little concerned about my crude oil position. It should have rallied more than it has here. But generally speaking, on a broader sense, it used to be thought that copper was a leading economic indicator for the stock market. Dr. Copper, it was supposed to be the wisdom of the stock market. I haven't found that to be true in recent years. And crude oil, some interesting studies came out this week on crude oil about supply and demand and price and how those relate. And it really indicates to me this is just a trading affair. This is driven by the commercials. When the commercials get heavily long crude oil, it rallies. So it's a commercially driven market. It's a real commodity. It has usage. It has consumption to it. It tends to be a pretty good forecaster of the stock market, not to the day, of course, but when crude oil gets real strong, we're probably going to have trouble in the stock market. Recently, though, and that's where stuff varies so much, when stocks have rallied, crude oil has rallied. So suddenly they're all moving together. The markets this year have been so unique, Tom, in that traditionally when stocks get really hit hard, bonds rally. That's almost a sure bet. This year, when stocks got hit, like the last couple of weeks got hit real hard, bonds didn't rally. Bonds went down with stocks. So that's why a trader has to really, we have basic axioms that we use, but you still have to deal with what's right there on the chart in front of you.
For sure. Thank you for that. That's great. Next question. Carmen asks, hello from France. Carmen's in France.
Hi,
Where
Carmen.
can I find more info from how to use the COT data in which market? Can you recommend a book or something?
Well, sure. There's a couple books that have come out on the Commitment Trade Report. I did one, Trading with the Insiders. It's old. You can probably get it on eBay. That seems to be the cheapest place to get it. Maybe Amazon. It explains my idea of the Commitment Trade Report, how to use it, and just what I showed you today. You probably don't even need to buy the book. Just watch a replay of this. A lot of information there. And of course, we do have our classes, our courses for commodity trading. We rely heavily on that. And I show a lot of other ways of using the Commitment to Trade Report. In fact, I'll go to that right now. We're going to do another group in October. And if you're interested in becoming a student, just go to ireadytrade.com/futures commodities. And if you're interested, we're going to start another course in October, and I will be involved personally in that course. It's not somebody else teaching. It'll be me and other courses that we've done. Okay, back to the gold forecast. Yes, Tom.
That's great. And I was commenting to my colleagues earlier, I really trade. I love that website. It says so much in 3 words about you, Larry, and about your history. I just always love that website. So that URL. But getting back to the questions, Dave V asks, what was the indicator Larry was showing for retail traders? So at the beginning of the presentation, when you were showing the retail portion of the COT index, possibly, he's asking which indicator was that?
Right. So again, for the small traders, they're represented in the Commitment to Trade Report by a group called non-reportables. In other words, that's a net difference between the commercials and the large funds, and whoever's left they call non-reportables, or which I call small spec. It used to be listed in the COT report back in the 1970s as small spec. So that's the public. And then we can make an index out of that. And I also look at that in a couple of other ways as well. But again, they're almost always wrong. So if you pull that data out of the Commitment to Trade Report, look for the non-reportables. That's what you're looking for.
Right. And Larry has made some indicators around that information. You can find Larry in the NinjaTrader ecosystem if you want to find more about his indicators that you can put on NinjaTrader as well. Carmen, go ahead.
No, go ahead.
Carmen has another question. I think it's a great question. Do you still use the same zones for the extreme positions? And the way I interpret that is, are those extreme positions, do they adapt to the data maybe? Or do you use kind of a set, like RSI uses 30-70 set levels?
The zones have stayed the same. There's no difference in the zones, but the way we construct the index changed monstrally once we went into electronic trading, and nobody else seems to have picked up on that. So how you construct the index from that basic data, the basic data is still there. It's really reliable, but how you use or manipulate that data, that's the real big difference. But the zones have overbought, if you will, oversold. Yeah, when the commercials get too heavily long or too heavily short, the zones have stayed the same, but it's the interpretation of the data, because with the internet, with electronic communication, things have changed.
Great. Awesome for that. Nathan asks, hey, Larry, great stream so far. Any insights on the methodology you use for creating your cycle forecasts on timing solutions?
Yeah, well, I always get that question. I say, guys, I'm still learning this. I do use software called timing solutions. It's not like NinjaTrader, which gives you live data, order execution, all that. It's something that allows you to study cycles. And sometimes I just go cycle crazy, and I am still learning it. So no great insights. I do share occasionally in the timing solution users group, but sometimes I just think I'm chasing my own tail here. I think there's a lot of value to cycles. I think I'm getting closer to understanding them, but I don't know enough to teach anything about it yet, frankly.
Well, thanks for that, Anthony. Thanks for the questions. If you have any questions, feel free to drop them in the chat. That resides at ninjatrader.com/events. We do have a couple more moments that we can take questions. But in the meantime, I really strongly recommend everybody go to Larry's website at ireallytrade.com at futures commodities. I'm sorry, www.ireallytrade.com/futures commodities, all one word, and that will take you to a place where Larry is going to explain about the registration for the next group of training classes. And Jim Cagney and I were fortunate enough to participate on the NinjaTrader side with one of your classes earlier this year, Larry, and that was that was fun. We had a good time with that, and hope that the rest of the classes were good for you.
Well, we appreciate you doing that, because that's part of learning to trade. It isn't just like buy here, sell there. You have to understand the software you're using. So we've been really lucky, and thanks, Tom, for you guys to come together with us and Jim and explain the software, because in the old days, I just called my broker and say, buy, add, buy, sell, whatever. And he'd say, oh, you meant buy or you meant sell? It's so different now with computers. I see so many people losing money because they don't understand the software. So when we do our teach-ins, if you will, we make certain that people from NinjaTrader are there to explain the software, because if you don't understand the software, guarantee it, you'll lose money because you didn't use the software correctly. So it's really an important part of education, is not just learn about the market, but you got to learn about the software too.
Right. And as you might know, I've been at several different software companies, and NinjaTrader to me is the most intuitive for traders. There's still a learning curve, but I think Larry, it's great to be working with you, and NinjaTrader certainly from the trading aspect is really easy to use once you know what you're doing. So we were happy to be a part of that. Renata has a comment, Larry. I don't know if you know Renata, who that is.
I do know Renata. Renata's a current student. Absolutely.
She says, congratulations, Larry, to be with us. I really appreciate that. So let's see. I think that's about all the questions we've gotten in so far. Any other comments that you have, Larry, about where people can find you, or anything else that's brewing?
Well, no, I mean, if they're interested in following me, fine. If not, you've got to find the person that you really relate with. I think there's so many educators out there, some really good ones, some that aren't, of course. But to really learn about the markets, you need to find somebody who you almost instantly, I get it. I see how this person's mind, how their theories work, because you can learn more from that. There's some aspects of the market I don't understand. I try to follow it, and it's so confusing to me. I know that's not my area of education, or to go to that teacher. When I first began, a guy named Gil Holler and Bill Meehan. I instantly understood what they're talking about. That's what you're looking for in an educator. Somebody go, yeah, I got it. I see how this works. If you're confused about my stuff or anybody else's, then that's not the right teacher for you. Find a teacher who you go, yeah, I get it. It'd be a lot easier for you to learn from that person.
Oh, great. Thanks so much, Larry, for your time here and spending time with us. You know what? One last question. I think it's important, relevant. Eddie asks, is the COT report specific to commodities? And curious if there is an equivalent in stocks.
Unfortunately, we don't have anything similar to stocks, but kind of drag this on a little bit. As I mentioned, I've been following the COT report since 1971, 72. And I finally learned from that how the commercials buy. So I have a synthetic index that almost, as we showed that a moment ago, almost looks exactly like the commitment to trader report for any market. It's so similar, a little bit of different, but not much. So if that's true, and it looks like it is, because we've been doing this for 25, 30 years now, I can use that same methodology in the stock market. So my synthetic commitment to trader report works really well in individual stock. Now, not the commitment to trader report. There isn't anything like that for the stock market. But knowing how commercials buy and sell using that model, that theorem, does have great application to stocks. So if you're a stock guy, yeah, you want to take my synthetic index and put that into your stocks, and then you'll have some really good conditional buys set up for individual stocks. But in terms of is there a report, unfortunately, there isn't. All we have, you have the insider buying, which is helpful. In this respect, insiders buy to make money, but they don't always sell. They may sell because they're getting divorced. They want to buy a house. Their selling is not as significant as a buying. And then we have the report of the fund's position. But as I mentioned earlier, that delayed data. So they may be out of it by the time we find. There was a big article, Tom, you probably saw it, where Michael Burry had his massive short option position on. Did you see that all over the news a couple of weeks ago? And that was a position he had way earlier in the year, but they just found out about it because the data was released. So there's such a huge delay in the stock market. There's nothing like that good old commitment to trade report for stocks.
Appreciate that. I lied. I have one more question, but it is from a subscriber to the Larry William indicators on NinjaTrader. Abdullah from Saudi Arabia wanted to ask if the money flow and overvalued will be included in the package. So if those are indicators,
I apologize. I don't know. Louise, my wife, handles all that. I don't know what are in the packages. And I get this all the time. I just have to remember that. I'm almost 81 years old. I don't remember hardly yesterday. But it's probably on the website, or just drop Louise at iReadyTrade.com, and she can answer that question. I'm the trader. She handles all the details. I apologize to you. I'm sorry.
Well, thank you for that. And thanks to everybody who contributed to the chat. We appreciate your involvement. And of course, Larry, we appreciate you coming on Traders Workshop and sharing your knowledge and wisdom. It's always a pleasure to talk to you.
Well, I continue to be amazed people that ask me to talk about the market. So it's just a really honor to do it. And I know we're able to help people learn more about the markets. And that's just great. I think that's what you guys are doing. You're expanding education. And that's what we all need. We all need to get a little smarter, a little better. And I hope I've contributed to that today. And until next time, Tom, to everybody, good luck and good trading.
Thanks, Larry. You're welcome back anytime. We'll be talking again. And thank you to the viewers for joining us for this show. We will finish the day with Jim Cagnita at Bar's Closing. In the meantime, have a great trading day.